People always ask me, how do we know Bitcoin is worth anything? How do we know it has any value? And the framing that I used in that write-up is that from my perspective, Bitcoin just provides a service. And the service is the ability to store wealth in a digital format without a government or a bank. And today, hundreds of millions of people around the world want that service. The reason this is a clarifying way to think about Bitcoin, again, it's a service, the ability to store wealth in a digital format without a government or a bank. It's because we're used to services having value.
It's not just another run for Bitcoin. It's more than just a breakout. No, the rules governing money itself are being rewritten by this type of financial earthquake. Bitcoin is currently trading at over $115,000 per share. It's only the appetizer, yet others think that's crazy. The actual feast has not yet been served. Let's consider this from a different angle. A staggering $100 trillion is under the control of institutional investors worldwide. Just 1% of it, or the crumbs, might be converted to Bitcoin, creating $1 trillion in new demand. If we raise it to 5%, we will be facing a $5 trillion deficit. In contrast, the Bitcoin ETFs of today only oversee roughly $153 billion. That is a floor, not a ceiling. The first inning of a trillion-dollar championship wave is currently underway. Furthermore, it doesn't end there. Companies all throughout the world have $8 trillion in cash on hand. Do you believe they will simply let depreciation of the currency and inflation eat it alive? No way. 10% of that money, even, may be reinvested in Bitcoin, adding another $1 trillion to the already blazing trajectory of the crypto. This is no longer retail hype. Boardrooms, balance sheets, and CFOs are all part of it. Recognizing the harsh reality, Bitcoin isn't a risky investment. It's insurance. Matt Hougan is excellent. The way that people view Bitcoin has changed. It's not a wager on the periphery. It's not magic money from the internet. These days, institutions recognize it for what it is. A liquid, uncorrelated asset with an unchangeable supply cap of only 21 million coins that is harder than fiat money and scarcer than gold. The sharks on Wall Street are aware that this is the rarest currency in history. What occurs, therefore, when immovable scarcity and irresistible demand meet? Fireworks. The kind that turns the previous bull run into a 4th of July fireworks display. We are discussing a financial explosion that has the potential to alter economies, portfolios, and the concept of wealth itself. That was the practice run for the most recent Bitcoin bull run. The primary event is this one. And why did Bitcoin go 10 times bigger? Won't be a question when the dust settles. How did I not see it coming? Is what they will be asking. Here are some snippets from Matt Hougan's interview. You should not overlook this crucial video. For more videos like this, please subscribe to the channel. Watch, like, and share this one. You can also enable post notifications. We appreciate your return. Watch the remainder of the video.
And the need for this insurance against the huge buildup of debt and currency risk that we're seeing in the macro environment. Yeah, absolutely. This is a question I get all the time because Bitcoin doesn't generate cash flows, right? The reason stocks has value is they generate cash flows. And people always ask me, how do we know Bitcoin is worth anything? How do we know it has any value? And the framing that I used in that write-up is that from my perspective, Bitcoin just provides a service. And the service is the ability to store wealth in a digital format without a government or a bank. And today, hundreds of millions of people around the world want that service. The reason this is a clarifying way to think about Bitcoin, again, it's a service, the ability to store wealth in a digital format without a government or a bank. It's because we're used to services having value. If you think of any company in the world, let's think of Microsoft. Microsoft provides a service, which is the ability to edit Word documents and do Excel and do Teams calls. And people pay Microsoft to access that service. If you want Microsoft's service, you buy a subscription to their software. The more people who want that service, the value of Microsoft goes up. The fewer people who want it, the value goes down. And critically, if no one wants Microsoft's service, the value of Microsoft is zero. The same thing is true of Bitcoin. The more people who want this service, the ability to store wealth in a digital format without a government or a bank, the value of Bitcoin goes up. If fewer people wants it, the value goes down. If no one wants it, the value is zero. The difference is you can write a check to Microsoft because it's a company with a CEO and employees. You can't write a check to Bitcoin. There is no CEO of Bitcoin. The only way to get the service that Bitcoin provides is to buy Bitcoin. If you buy Bitcoin, you get the service. But other than that, it's simply identical. More people want it, the value goes up. Fewer people, the value goes down. No one wants it, the value goes to zero. What we show in this report is that more and more people want this service. And with US debt at $36 trillion and growing, with money printing going around the world, I think more and more people want the service of storing wealth in a digital format without a government or a bank. And that's what creates the value of Bitcoin. Yeah, I would just add, I mean, it's totally crazy. It's out of control, right? Like growing up, we always had debt and deficits and we worried about it. But since COVID, it's exploded. We're running 6 or 7% budget deficits during times of economic growth. Just the interest on the debt amounts to $6,000 for every taxpayer in the US every year. Just the interest. That's like the minimum charge on your credit card bill. And that keeps compounding because we keep spending more and more money. So, the need for insurance is directly related to the scale of the risk. I live in California. The need for fire insurance is high because we have a lot of fires and the conditions are ripe for more fires. In the US, the need for insurance against this fiat debasement has gone from small to really significant, and it's gotten on a life of its own. Like, I think there is no way out at this point. We've tried everything. The government's just going to keep spending money. It's the only thing we agree on as a country is we should print and spend more money. And so I think you need a little bit of insurance, and Bitcoin is exactly that.
When deciding how to allocate their investments among stocks, bonds, real estate, and cryptocurrency, investors must consider long-term capital market assumptions. In the absence of trustworthy information on predicted returns, portfolio construction is a wild guess. Bitwise recently developed a data-driven prognosis on Bitcoin's future role, concentrating on macroeconomic issues including rising debt and currency instability. As interest in the cryptocurrency from significant institutions increased, the value of Bitcoin stems from its ability to provide a digital means of wealth storage independent of banks and governments. Millions of people worldwide are drawn to this special service, and its worth fluctuates according to demand. Bitcoin doesn't have a CEO like businesses do. The only way to use this service is to own Bitcoin. Global money creation and rising debt have raised demand for this kind of financial security, which has raised the value of Bitcoin. The financial environment was shaped by two significant events: the emergence of QE following the 2008 financial crisis and geopolitical actions demonstrating that central banks may no longer have access to conventional assets. While gold has historically been used as a store of value, Bitcoin is a desirable contemporary substitute because to its portability and divisibility. Hougan believes that it might someday become one of the hard currency assets owned by central banks, along with gold. Let's get back to our interview.
All fiat currencies fail over time. And even, silver currencies failed over time because people could physically clip the coins to create inflation. When you have the easy button, when you can just push a button to create more money, to spend more money, you're going to do that. And so, the track record of fiat currencies is just abysmal. I would add, yes, things are fine. I'm 49 years old. The dollar has lost 85% of its value in my lifetime. That's pretty remarkable, right? It's lost 30% of its value since COVID. People are struggling from a living standards perspective to keep up with those rising costs. And the problem really just gets more and more acute. I mentioned that interest payment. Interest is now the third largest item in our federal government. There's Medicare, there's Social Security, and then there's interest. And it actually comes ahead of things like defense. So the problem that we were worried about in the Reagan era and the Clinton era is now at a crisis level. You can think of it as from an individual perspective. If you have like $100 on your credit card bill, you're not in a crisis. But when you have $100,000 on your credit card bill, it's just impossible to get out of that for many people. And that's sort of the situation that we're approaching. So yes, we've been worried about it for a long time, but the pressure has increased dramatically as the scale of this debt has gone up. Two pretty fundamental changes in the monetary ecosystem over the last 15 or so years. One was after the global financial crisis when we discovered the tool of quantitative easing. And that was not something that had existed in our vernacular. And that really led to a dramatic expansion of money printing. The second one was when the US government seized Russia's treasury assets, when they invaded Ukraine. which is really a signal to central banks around the world that, those assets aren't yours. You're sort of renting them. In the same way, some people are shocked to discover that they don't own the books on their Kindle, that they're effectively renting them from Amazon. It can be revoked. We found out that governments don't own their treasuries. The US can just take those away. And I think that was a shot across the world that central banks need to diversify into, assets that can be held on a sovereign basis. And that's gold. The other thing I would add, I think that's what's driving the purchases. One of the reasons I'm with Ryan that I think they'll move into Bitcoin is, if you think of the history of money, the reason people used gold instead of silver was that silver is too bulky. Gold is much more dense, stores much more wealth per unit. And so if you needed to move $1 billion of gold, you could do that. $1 billion of silver would be basically impossible. Bitcoin is infinitely more transportable, storable, movable, useful, divisible, etc. than gold. And so I do think over time, as this asset matures, you're going to see Bitcoin sitting side by side and then eventually, maybe someday, on parallel with gold in terms of central bank deposits. It's just a continuation of the idea of more dense, transportable. Poorly understood. We say these things about gold like it's existed in this one format versus fiat currencies for thousands of years. And that's because most people don't remember or haven't studied gold pre-1971, right? It was $35 an ounce for like 50 years. And before that, it was $22 an ounce. There was a one-time revaluation, and that was fixed, right? Like a flat line. Pull up a fiat, an actual dollar line of gold, and it's just like flat line up, flat line. And then in 71, it goes crazy. Because in 71, we severed that, and suddenly it was measured against fiat currency. One of the things we show in the paper, which I think is really interesting, we think there are a lot of analogies for gold in the 70s and 80s versus Bitcoin today. Again, I know we all think gold is this timeless asset, but in the 70s, there were real questions about what role it would play in society. People described it as a barbarous relic, like something from the past that was no longer relevant. And if you look at the price, what you saw is the price went way up. It went from $35 to over $800. Part of that was inflation, but part of that was the world discovering that gold had a place in society. And once it did, the value of it went up. I think the same thing is happening in Bitcoin. People are discovering that Bitcoin has a place in society and the value of it went up. What we note in the paper is that over time, from about 71 to 97, gold's volatility declined as people came to accept it. Right? In 1970s, it was hugely volatile. We think of it as steady today, but it moved 3% or more every third day. It was hugely volatile, but that volatility declined over time. I think the same thing is happening in Bitcoin. Its volatility is declining over time. Eventually, it will reach some steady state where it's much more valuable than it is today and lower volatility. But yeah, I love that you bring it up. There's so many parallels between gold in the 70s and Bitcoin now that I think people could do themselves a favor by studying it. Institutions are increasingly looking at it. That's the first and most important point. As I mentioned, we received more than a dozen requests for this report. That's because institutions are looking at it. Or if you just think from a big picture perspective, crypto is now a $4 trillion market. That's too big for institutions to ignore. So to get to your question, what do they see when they look at it? They see an asset that has high historical returns. They see an asset that is historically pretty volatile, more volatile than stocks. They see an asset that is liquid. And importantly, they see an asset that dances to its own drummer, that's not correlated with stocks or bonds. It moves in different ways. And when institutions build portfolios, what they're looking for is a combination of assets that work together and where the sum is greater than the parts. And the key to that is having these assets that move in different ways, right? That's why they bought US stocks and international stocks. That's why they buy stocks and bonds and real estate. And crypto is another one of those vectors. So we think institutions are going to allocate a significant amount of capital to this space. The World Bank says there's $100 trillion in institutional assets under their control. We think it could be 1% to 5% in Bitcoin because it is such a nice addition to portfolios. That's $1 to $5 trillion of investment. Right now Bitcoin ETFs hold 170 billion. That means we have a long way to go. So I think they see it as a very exciting asset, an important asset, and one that they're going to allocate to in the coming years. Add, if I can, this is a big market. Companies now hold about $8 trillion in cash on a global basis. If you think 10% of that is coming into Bitcoin, that's getting pretty close to $1 trillion, right? Again, the whole asset, Bitcoin as an asset, is $2.5 trillion. So $1 trillion of buying power, which you could easily see from corporations over the next handful of years, is a really lot of money, right? Companies have a lot of money and they're worried about debasement just like the rest of us. I mean, limited supply is the key of Bitcoin, right? There will only ever be 21 million Bitcoin. There's about 19.5 million that's already owned. And every year right now, the inflation rate of Bitcoin is about 0.8%. In other words, about 164,000 Bitcoin get created every year. That's it. That's important in a couple of different perspectives, just to put it in context. One is that compared to gold, it's actually much more scarce, right? The average inflation rate of gold is, call it 2%, sometimes 3%. So Bitcoin today at 0.8% is significantly more scarce. And importantly, that's going down. Gold's inflation rate has stayed roughly the same for the last 100 years because people can mine, they can open new mines, they can discover it in new places. There's no discovering a deposit of Bitcoin. There is only this 21 million, and the amount of new supply is actually going down over time. The report is relatively sophisticated, but if you wanted to boil it down, you could say there's only 164,000 new Bitcoin per year right now, and there is more than 164,000 Bitcoin of demand from institutional investors. There's more demand than supply, and so the price goes up. I think that is a core element of Bitcoin. It's demand, inelastic, supply, just a fixed amount.
According to Matt Hougan, people frequently misunderstand the importance of gold because they forget how constant its price was before 1971, when it was set at $35 an ounce for decades. Only after the U.S. abandoned the gold standard that year did it begin to fluctuate. He highlighted some intriguing similarities between Bitcoin now and gold. In the 1970s, some people at the time thought gold was an antiquated, savage artifact. However, a sharp rise in price indicated that people had once again recognized its worth, particularly in light of inflation. Gold's price fluctuations eventually subsided, indicating wider acceptance. Hougan thinks that as its volatility gradually declines, Bitcoin is going through a similar process of acquiring mainstream recognition due to its high returns, liquidity, and lack of correlation with stocks and bonds. Institutions are becoming more and more interested in Bitcoin, which is currently a $2 trillion market. When integrated in portfolios, they value assets that exhibit distinct behaviors in order to lower risk. He pointed out that the supply of Bitcoin is strictly restricted to 21 million coins, with only 164,000 new coins produced annually, a restriction that is far more stringent than that of gold, which is still mineable and addable. Matt Hougan added that although there has been improvement in recent years, regulatory risks still exist. Although regulations may change, he anticipates that they will become more pro-crypto as its use increases. Regarding macro risks, he concluded by saying that although investors are concerned about the possibility of hyperinflation or a move away from the U.S. currency, these are not the most likely outcomes. Do you believe that Bitcoin will soon play a significant role in investing portfolios given the growing institutional interest and the cryptocurrency's resilient price? How do you view Bitcoin's function as a hedge against exchange rate and inflation risks? Kindly provide your thoughts and insights in the space provided for comments below. In order to see more videos like this, make sure you like this one, subscribe to the channel, and enable post alerts. I appreciate you watching.